So you're receiving startup stock, but it's worth almost nothing. Do you really need to file this Section 83B tax election? The short answer is yes. This one form could save you tens or even hundreds or thousands of dollars in taxes later, and it only costs the price of sending in the mailing and making copies. I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. And today we're tackling one of the most misunderstood tax strategies in the startup world, whether or not to file the Section 83B tax election. This is a move that could make or break your exit tax planning. Okay, so here's what we'll cover. What a Section 83B is and how it works, why you should file Section 83B potentially, even if you have zero taxable income, what non-US founders need to watch for, what could happen if you don't file. And finally, we'll discuss generally some instructions and the form. So what is a Section 83B election? If your startup stock vests over time, the IRS will normally tax you as the shares vest, which can become expensive fast. Another note on this point is the concept of a repurchase option. For founders specifically, you may receive all of your stock up front, but the company may have the right to repurchase a percentage of that stock over a certain amount of time to the extent you leave within the first set number of years. This functions similarly to the context of vesting. It's not actually vesting, it's a repurchase option. Why does this matter? Well, again, because you have this repurchase option that falls away over time, the IRS and tax authorities will look at this at each time that vesting drops off, or at each time that repurchase right drops off. There may be a revaluation of the percentage of stock that you actually own. With a Section 83B election, you're telling the IRS, pretend that I already own everything and tax me right now. In an example, let's say you have shares and they are at par effectively, so 0.00001 per share. And that usually is going to mean that you're going to have no or very low tax today, but potentially big savings later. So why would you file even if your taxes are zero? Well, the key benefit for making a Section 83B election is that it freezes your future income tax exposure and you start your long-term capital gains clock. And this helps you avoid tax surprises when you cannot sell those shares potentially in the future. So let's use a simple example. A founder receives 2 million shares at the start of the company. So we're talking day one, day zero. At that point in time, you basically just formed your entity and the price per share is something very nominal, such as 0.00001 per share, which is going to be 2 million shares. You're looking at about $2. So why would you file a Section 83B election here? Well, if you want to lock in your tax basis on those founder shares, so you're basically telling the government these shares are worth $2, and you start your long-term capital gains tax treatment on that day at that time. What if you're a non-US founder? Well, the Section 83B election may still apply if a few things are applicable. If you earn US source compensation, this is a specific tax term, so of course, as with all things tax and legal, you'll have to consult with your own professionals, but let's use a simple example. If you are a non-US citizen, let's say a non-green card holder, and you live in a country that is not a US territory, right? So you live in Europe somewhere, but you may be a founder in a Delaware C Corp that is a startup. In that case, you will potentially earn your income outside of the United States because you live, pick your country in Europe. And if you are not relocating to the United States during the period of time where your shares may fall out of the repurchase option, or where they may vest, then you potentially could say, you know what, this doesn't apply to me. I'm a non-US citizen. I have no intent to move to the United States. I don't need to go about the process of making this filing. Filing early can prevent future tax complexity. What happens if you don't file? Without filing, you owe income tax on each vesting event. You lose your long-term capital gains and you face potential painful tax filings. And what if your startup has an exit in the future? Well, you may miss out on what's called QSBS election, which is qualified small business stock. And this allows the holders, the early holders, to receive potentially up to $10 million tax-free, subject to meeting the requirements of QSBS. Be on the lookout for future videos going more in depth on QSBS. And I also have some other videos where I've touched on these topics as well. And I'll put a link below in the description if you want to check those out. So you think you may want to file in Section 83B. How exactly do you do that? Well, there's one of two ways. Historically, Section 83B as a form did not actually exist. There was no set form from the IRS, and folks would usually work with templates they could find online and or their local counsel and or CPA to make the relevant filings, provide the relevant copies to the company, to the IRS, and keep for themselves for records. Starting at the end of 2024, the IRS has released Form 15620, and this is a standardized form that you can use to make your Section 83B filing. And note that it's not required to be used, but I would recommend that all founders take a look at it because it's a great template and it has an explanation section at the very end that walks you through how to fill it out. And whether you use the form or not, it will have answers to a lot of common questions. So I'll put another link to that in the description below as well. So what are some key takeaways of the form? Now, again, I cannot give you specific tax advice or legal advice on how to fill out the form, but I can give you some tips on what the form is saying and how you need to think about it generally. So what's the single most important thing about the form? The most important thing about Section 83B tax election is that that election must be made within 30 days of your grant. What does that mean? The grant does not mean within 30 days of the day you decided to open the DocuSign and actually sign the agreement. No, it means the date on the agreement that it was first granted to you. So it's a 30 calendar day window. Holidays don't matter, weekends don't matter. And if you miss the deadline, as far as the time of this video, there has never been any sort of guidance to give people some sort of grace period. The next critical point is that you need to make 3 copies of the form. The 3 copies of the form, one will need to go to the tax authorities, one will need to be kept in your records, and one will need to go to the company. And typically you're going to send the wet ink signed original to the tax authorities, the IRS. Okay, so let's recap. Section 83B lets you treat the stock you may have received today in income and potentially lock in capital gains tax treatment that's more favorable for the future. It starts the capital gains tax clock immediately, and it helps you avoid potential tax headaches and audit risk. For non-US founders, you're gonna have to look at your situation specifically, and the key takeaway here is if you're not in the United States and you're not in the US territory, and you don't have a plan to relocate permanently to the United States or become a green card holder, that sort of thing, then you most likely would not need to make the Section 83B filing. However, you will have to consult professionals to discuss your own facts and circumstances. Finally, filing is relatively straightforward, but you have a 30 calendar day deadline from the date of grant to make the filing. Join me on the path to decoding law, technology, and innovation to grow your business. And don't forget to like, share, subscribe, and hit that notification bell. Until next time.